So yes, as I said, the New South Wales Dairy Breakfast webinar, I do acknowledge that it's a late breakfast today. But today's topic is the 2022-23 Dairy Farm Monitor Project findings. But before I start, I'd just like to acknowledge the traditional owners on the lands in which we are meeting today and pay my respects to elders past, present and emerging. And I'm on Yuin country today. So the Dairy Farm Monitor Project analyses approximately 250 farms across Australia, with, for this year in review, 36 in New South Wales. And New South Wales delivers this project in New South Wales DPI delivers the project in partnership with Dairy Australia, and it's a 12th year of results. Sheena Carter, our Development Officer in Dairy Farm Business Management and leads the Dairy Farm Monitor Project in New South Wales, will be presenting the results today. And if possible, if you could hold all your questions off until the end, and there'll be plenty of time at the end to ask questions. So I'll hand over now to Sheena, who will take us through the results. Thanks, Sheena.
Thank you, Ken, very much. I'm just wondering what people can see on my screen. Can you see a little black box that says Talking Sheena Carter? No?
See the slide?
Okay, good. I was just getting other things popping up, and I was hoping that you weren't seeing that related to the Zoom meeting. Thank you very much, Ken, and thank you to everyone for joining the webinar today to hear about the performance of the Farm Monitor farms for last financial year. Ken's explained how the project operates in New South Wales, and yeah, with joint funding and support from Dairy Australia and DPI Dairy Unit. This is the 12th year of the project in New South Wales, so it is a long-term project that is highly valued by everyone that participates. So for those of you that are new to Dairy Farm Monitor, I do see some new faces in our call today. It's a project that provides standardised and comprehensive physical and financial analysis of farm business for performance across the state, and it gives the dairy industry, dairy farmers, government and others very good objective farm level information that's used for targeted strategy, prioritisation and decision making in the industry. Firstly and foremostly though, I must thank very much the farmers that participate in this project. We've had some very long-term participants, some participating for the full 12 years, to some new recruits this year. So sincere thanks to them. Without them, this project doesn't happen. So I hope they find value in the reports that they receive as well, because they are comprehensive and give a very good summary of their farm performance for the year. The data is also used as the validated data that sits behind Dairy Base and the Farm Business Snapshot. So for those that aren't aware, they are free online tools available to farmers and industry, so that you can do your own farm business analysis, and you can look at that in relation to the performance of others that have similar features to you. The information is also used in reports like the Dairy Australia's Situation and Outlook report, the In Focus annual report that they produce as well. So it's widely used across industry, and because it gives us that good impartial picture of how farmers are dealing with conditions that they're dealt with in that 12-month period. It also gives us trends about the industry over time. And it also enables us in New South Wales, we're a big state and we've got lots of farms operating in very different conditions. So it enables us to see some of the regional differences across New South Wales. So I'd also like to thank, while I'm doing my thank yous, the data collectors, some of whom are on the call today. Thank you for your efforts in pulling the files together. It is a process. There's lots of backwards and forwards in trying to get the files as accurate as we possibly can. And also a big thank you to Fiona Smith for her support and validation of our New South Wales data. Oh. Okay, so this map illustrates the approximate geographical location of the 36 farms that participated in the project this year. So you can see from top to toe and covering all dairy regions of New South Wales. The green dots are our north farms and the pink ones are our south farms. So you can see that we really do have a good distribution across the state of farms. The overlay is the rainfall decile month for the 12-month period, the 12-month financial period across that year. So that shows that we had some sort of changing conditions throughout the years, some very wet conditions, as I'll go into, and as many farmers will remember very clearly, flooding in a lot of locations and prolonged wet periods that really impacted performance and how farms were managed in that year. But we did also see, particularly up in the far north coast region, we can see that they really started to dry out and entered drought towards the tail end of the year. And that was also experienced in the far south coast and parts of the Hunter as the year progressed. So 36 farms I mentioned, we do have movement in and out. We had 6 farms opt out from the previous year, but we replaced them with 6 other farms, and some of those 6 were returning farms. So they've been previous participants in Farm Monitor. So it's great to have them back in, and it's excellent to have new participants in the project as well. So within New South Wales this year, we had, well, at the end of that financial year, there were 466 active dairy licences. So that means that our farms in this data set contribute, or they're 8% of the New South Wales industry. So it's a snapshot into the industry. You know, it's not a performance analysis of the whole New South Wales industry. It's a snapshot. My analogy for this is it's a bit like milk prices. When milk prices are announced each year by the processors, really they're an indicative price. And as a farmer, it's important to actually get a milk income estimate to understand what your milk price is. Same with Dairy Farm Monitor. As a farmer, if you want to understand what your performance is, you need to do a dairy base analysis or a farm business snapshot analysis, and that will tell you how you have actually gone. So this is really a snapshot into the New South Wales industry through the lens of these 36 farms. And with that, I always give this slide, you need to use caution when you're looking at the data. It's a summary of the participating farms only. I've just explained that. And we get movement of farms in and out of the project between years. So you have to be careful when you're comparing between years. We've also got to context the numbers. Numbers just aren't numbers. Every business has different goals and aspirations. Not every business wants to be the most profitable dairy business in New South Wales. People dairy for all sorts of different reasons, and that's how they operate. They also deal with different conditions on farm throughout the year, depending on where they are within the state. So when we're looking at farm performance, we look at 3 main areas to understand farm performance as a whole. So they are the cash performance, the profit performance, and the wealth performance. So the cash is pretty easy to understand for most people because it's, you know, simply have you got enough cash to pay the bills that are due in operating your business and financing costs, etc. So it was a strong cash flow year for New South Wales. Our net cash position was much stronger than the previous year. It was an average of $268,903, up from $83,511 in the previous year. And this was primarily driven by the stronger milk prices. When we're looking at profit, profit is an efficiency measure that tells us how well the capital is used in the business to generate a profit. So we're looking at operating profit. We look at obviously our gross farm income, taking away our variable costs and our overhead costs to give us our profit. Our efficiency measure is dollars per kilo milk solids because that is the basis on which most processors pay. So when we're looking at our costs and profit, there are some non-cash costs in there as well. So this is not a cash position because it factors in non-cash costs. Those non-cash costs are things like depreciation, so the cost of machinery to you over time. Ultimately, you're going to have to replace that again. The value of imputed labour, and we standardise the value of imputed labour in Dairy Farm Monitor because if we were just to look at a farmer's drawings, every farmer takes out different amounts of drawings in a cash sense. Depreciation, imputed labour, and also inventory changes, so feed and water and livestock inventory changes over the course of the year. So for this year, our average profit increased on the previous year to $2.78 per kilo milk solids on average across the state. There are regional differences, and that translated to a 6% return on total assets. So this is up over $1 per kilo milk solids on our 21-22 year, where we had $1.71 EBIT in that year. So it has been a very strong year, and we'll go into some of what has driven that in the upcoming slides. I think it is a strong year, and it's pleasing to see, and I think it's a strong result despite the challenging conditions that were faced by pretty much every farm in our Dairy Farm Monitor group. The next thing that we look at is the wealth position, so our net worth. What we're really interested in as farmers, well, generally, is are we increasing our net worth, so our equity over time? It's a bit easier to understand than profit because it's assets minus liabilities. That's your equity. Hopefully over time your equity is increasing. And we saw an improved equity position across the course of the year for 29 of 36 farms in the data set. Obviously, assets minus liabilities. We did see an increase in liabilities, which I'll expand on, but with an increase in liabilities comes an increase in financing costs, so our interest and lease costs. These were 35% higher than our previous financial year, and this has been driven by significant increase in plant and equipment loans in the data set. They're up an average of 49% on the previous year, and also an increase in the long-term liabilities on many of the farms. So for the context, rainfall. We capture rainfall for each of the farms, and this will show rainfall between the north and the south, so across the year, our rainfall on the left. For the north farms, we can see that we had some particularly wet events during the year in that, spring, summer period, and then over in the March period, we've got a big uptick over here, that's predominantly driven by a large rainfall event on the mid-north coast of New South Wales during March. The south, again, we've got some very wet conditions. There was a lot of flooding, particularly you might remember in the inland region around just before Christmas last year, and again in that autumn period as well. So these flooding conditions resulted in disaster declarations across many local government areas throughout New South Wales. And with disaster declarations comes access to grants, which the vast majority of farms in our data set received grants due to those conditions. and I'll explain how they are handled in Farm Monitor a little bit later. We can see here, though, all of a sudden the tap turned off. Pretty much by the end of the financial year, things were incredibly dry, which, you know, from flood to drought in parts of the state in a pretty short time period, unfortunately. Looking at milk intake amongst the group of farms, so we look at monthly milk production in Farm Monitor, we capture that. This graph shows by month the proportion of milk intake. So we can see that this is our north and this is the south. So New South Wales, a pretty flat milk supply curve, which is no surprises given that we are predominantly a liquid milk market. So we want a flat supply curve year round. Interestingly, and I haven't got the previous year's graphs obviously here, but normally we see a bit more of a differential in the spring and autumn period between the north and south. This is sort of flattened out a bit this year, potentially as a result of, you know, the flooding, because this year wasn't the only wet year. The previous year was an incredibly wet year as well, and obviously that has impacts on herd health and cows, things like fertility. So perhaps some of that is sort of flowing through, but also strong milk price signals encouraging milk production, and those strong milk price signals coming from the processors is evening that out a bit. So I think you know, we're seeing a lot of marginal milk being produced, and by that I mean, you know, we've got high milk prices relative to feed prices, so farmers are comfortable buying in that additional feed to support milk production. This little uptick here in the north at the end of the year, that is mirrored in Dairy Australia's milk production reports, and for the North Coast region there was over a 10% increase on milk intake this June relative to the previous June. So I guess some of that sort of you know, strong price signalling enabling that to happen, and also a return to better conditions, although it was particularly dry up on the far north coast at that point. So from a state perspective, so I'll be talking about the performance from a state perspective, but also from looking at some differences between the north and south of the state with our farms. Flooding, prolonged wet conditions, I have mentioned this already, and this slide's pretty similar to the previous year's slide where we had very similar conditions again. So I mentioned earlier, when we've got a disaster declaration, grants become available to farmers because of that. So there was a special disaster grant made available, and transport subsidies for fodder freight, which the vast majority of farms from the top of the state to the bottom of the state to inland were able to access. When we have grants or rebates within Farm Monitor, the methodology is that those are netted off the related expense item. So, for example, with the flood damage, we get damage to laneways, fences, and you know, irrigation equipment, those types of things. So, where there's abnormal repairs and maintenance to laneways, that is netted off. In that instance, repairs and maintenance would have that cost netted off because it's an abnormal cost. It occurs also in instances like where we have fuel rebates. So farmers as primary producers get a fuel rebate, and that is netted off fuel and oil costs. And so where the transport fodder subsidy has been provided, that gets netted off the cost of the feed as well, just for context, so you understand how that works. The performance, so $2.78 EBIT, highest in 12 years. The performance was primarily driven by the stronger milk prices across the state. There was a slight reduction in livestock trading profit, which also makes up part of our gross farm income. Feed and water sales declined slightly as well, probably because there was less available to sell on farms, and other farm income decreased slightly as well. So I think I've just mentioned livestock and feeding sales. Higher input costs were still experienced despite the grants being available. Obviously, that only affects a certain portion of costs in the business. The most notable of these costs was purchase feed and agistment, and this is in both the north and the south. Obviously, they're having to replace feed that wasn't available because of the wet conditions. Purchase feed and agistment costs increased by 25% on the previous year to $3.50 per kilo milk solids on average for the state. I said the impact was similar across north and south. It was 28% increase in the north and a 22% increase in the south. So purchase feed and agistment costs make up part of our variable costs, and we saw variable costs increase by, was about 17% across the state. Variable costs, we've also got herd and shed costs within that. There were slight increases in the herd and shed costs as well. When we look at overhead costs, I mentioned before, there's cash and non-cash costs. Interestingly, so overall overheads increased by 7%, but the biggest, or one of the biggest increases was with depreciation, which increased by 13% on average. The biggest impact here was in the north. The depreciation cost increase was 25% in the north. This has been largely due to farms spending more on plant and equipment. So, for example, we've had a number of farms that have installed feed pads in the last 12 months as a strategy often to deal with the repeated challenging conditions that they've faced. So whether that's drought or flood, just enabling them to continue to feed herds well and keep them out of wet or very hot conditions. So there's been that sort of an investment, and we'll get depreciation on plant or infrastructure in that instance, but also equipment purchases, so machinery. There's a lot of machinery that has been purchased in the year. Obviously, that incurs depreciation costs. So some of that machinery would be associated with the feed pads, but it's not just machinery associated with feed pads. Some of the things driving this will be obviously, a stronger cash position on some farms, but there's also been influences such as the instant asset tax write-off. And we also need to remember that machinery has become more expensive in the last couple of years with supply chain issues, new machinery, but also second-hand machinery that has increased in cost because of the same reasons. If we look at labour costs, total labour costs increased on a dollars per kilo milk solids basis, but this has mostly been driven by an increase in the cost of imputed labour, and particularly in the north of the state. So what's kind of happened is, on average, the proportion of imputed labour relative to paid labour has increased in the north compared to what it was in the previous year. We also have had a slight increase in the hourly rate, standard hourly rate that we apply to imputed labour. So previously it was $34 an hour. This year it's $36 an hour. And this just details how that performance has changed relative to the previous year. So $2.78 EBIT, which in whole dollar terms is $691,000 per farm as an average EBIT. To get net farm income, the $549,000, that is our EBIT less interest and lease costs. So that the EBIT translated into a 6% return on total assets, and average return on equity worked out at 11% this year, and I'll explain later on why there's been a slight reduction in that. So some of these influences around the seasonal conditions really. This graph shows at the pasture removed from the milking area over the last 5 years. So the dark blue component of the bar graph is grazed feed, directly grazed by the cows, and the light blue is conserved, so hay and silage. So we can see that over the 5-year period, there's been a bit of bouncing around. Those first 2 years, that's the impact of drought. Then the 2021 year, we had a return to some more normal conditions, but then the impact of wet conditions. So, you know, our estimated pasture removal from the milking area has certainly declined because of that. And I think, you know, we've had lots to recover from, but it's meant that I think particularly with our grazed pasture, we've really sort of seen that come back, and hence, you know, having to purchase more feed in. And there was a bit more hay and silage made on milking area in this year relative to the previous year. If we look at fertiliser, again, a similar trend, declining with drought conditions, return to better conditions. The 21-22 year was, you will recall, a year that had two things impacting it. One, extremely wet conditions, but also extremely high fertiliser prices, record high fertiliser prices. So in this year, we've seen slightly better conditions towards particularly in the second half of the year, which has enabled people to put fertiliser on, but also we've started to see fertiliser prices soften from what they were in that 21-22 financial year. So if we look at the differences between the north and south, and there's always differences between the north and south, and there's many factors driving this, which is another webinar in itself. But we do see variation between operating profit in the north and south. So this graph, our left-hand axis is our EBIT, which I'm referring to as operating profit, earnings before interest and tax. So each of these dots represents one of the 36 farms. The green dots on the left are the north farms, the blue dots are the south farms. So we see the north had an average EBIT of $2.52 per kilo milk solids, and the south, I've got something blocking my screen, but I think it was $3.01 per kilo milk solids. Some of the differences in like big high level differences that we see between the north and south are milk price. The further north you go, you get an increase in milk price for various reasons, but that differential between the north and south is generally about $1 per kilo milk solids. North also had slightly higher livestock trading income and other income relative to the south, but our operating costs, our variable and our overhead costs in the north were $1.73 higher than what they were in the south. So a bit more detail if we now sort of look at the north on its own. Flooding impacting our feed base, you know, inability to graze pastures, inability to conserve pastures and crops impacting, and hence having to purchase in more feed. So there was a 0.7 tonne of dry matter per milking hectare reduction in directly grazed feed in the north, and only a slight increase, 0.1 of a tonne in conserved pasture on average across the groups. Herd health and production, herd and shed costs were similar. There wasn't much change. They were similar to what they were the previous year in the north, but we need to remember that the previous year in the north was particularly wet, and we saw an increase in herd costs partly because of that. And so I guess, you know, it's still at the same level that we saw in that previous year. Other things in herd costs are AI, So things like we're seeing increased use of sex semen and genomics, which is also impacting those costs with time. Farm infrastructure, I've mentioned, damage to laneways, fences, etc., having to be repaired because of the floods. And, that's unfortunately for some farms that it's a repeated exercise from the previous year as well. But, there were the funds available through the grants to help farmers cover the cost of, that abnormal cost to their business. And I think it's important to, again, mention the people. This is all about people. Dairy farming and business is all ultimately about the people within it. And people, feel the wear and tear. We do a survey of farm monitor farmers as part of the process. And there's been a number of them indicate their intention to exit the industry in the next 5 years, partly because of that constant, managing challenging conditions. So our gross farm income, milk income, livestock trading and other farm income was the highest in 12 years at $13.32 per kilo milk solids. And the average milk price in that was $11.97 for the North Farms. The profit position, 16 of the 17 farms had a positive profit. And one farm really has struggled with cumulative years of challenging conditions. And then our operating costs, our overheads and variable costs increased an average of 11%. So again, that split, looking at the difference between the 2 financial years, a market increase in EBIT compared to the previous year, both on a dollars per kilo milk solids basis and total dollars. And again, once we take away interest and lease costs from EBIT, we get our net farm income. So for the North, that was a 4.3% return on total assets and average return on equity of 12.1%. So that has declined for quite a few reasons, but there were a number of farms that had interest and lease costs that were higher than what their EBIT, the EBIT they generated was. So EBIT gives you your net farm income, and that's factored out. For the South, again, same conditions. I mean, it's a big state, but it was a crazy year for seasonal conditions to be so widespread and impacting so many people. Again, the feed base impact, inability to get on pastures and graze them, inability, for timely sowing, for fodder conservation with hay and silage, and having to purchase in additional feed. There was only 48% of the energy consumed by milkers came from homegrown feed this year, which is down from 51% in the previous financial year. In our South data set too, we do have a number of TMR farms, total mixed ration farms, so zero grazing, all the milker diet is brought to them. So only 7, there's probably about a handful of TMR farms, but we only had 7 farms out of 19 that had more than 50% of their energy coming from directly grazed pasture. What else? Herd health costs. So herd health and shed costs actually increased more in the South than they did in the North, and possibly the impact of that, those wet conditions that for some hadn't been experienced in the previously, like had occurred in the North. Again, still the impact of farmers adopting sex semen and genomics in their breeding program as well. And farm infrastructure, same as the North, the impact that the floods had on farm infrastructure, laneways, etc., impacted repairs and maintenance, but we did have the grants support the cost of that on most farms. And again, the people impact that it has on people over time. It's a draining exercise, actually managing the conditions when you're faced with them, but also the flow-on effects. the flood waters don't recede, and that's the end of it. It's an ongoing process. So our gross farm income for the South was the highest in the 12 years at $12.08 per kilo milk solids, and the average milk price there was $10.94 amongst the DFMP farms. So that's up from $9.58 the previous year. A slight decline in livestock trading profit and other farm income as well. All farms in the South had a positive EBIT, and the operating costs, total operating costs increased by 20%, which reduced some of that potential margin, even though it was particularly healthy. So we see average EBIT for the for the South was $3.01, or 982,000 total dollars, taking away our interest and lease cost to give us 821,000 net farm income. So that EBIT in the South translated to a 7.5% return on total assets, and we had an increase in return on total equity to 9.9%. So where does this all sit in relation to the previous 12 years? So down the bottom, we have each of the 12 years and our EBIT on the left. For the South, we can see that there has been considerable fluctuation in EBIT across time. Likewise, with the North, there is fluctuation in the profitability in the North. Obviously impacted by many factors, such as clearly milk prices supporting a strong industry at the moment, but we've had things like tier 2 milk, droughts, price collapses, drought, and extreme wet again. So there's all sorts of things that drive our performance, and it has fluctuated over time. But if we look at, this is our average performance over the 12 years. Sorry, so we see $3.01 EBIT this year and $2.52 for North. Our average EBIT, and this is adjusted for inflation, for the South is $1.79 over that 12-year period, and for the North it's 97 cents per kilo milk solids. And I did actually take a look at that, if I can find my spot, in relation to what it looks like over the last 5 years. The reason I did that is because of in an industry target of $1.50 EBIT averaged over a 5-year period that has been set to try and generate an industry that is viable and growing. So if we looked at the North, over the last 5 years, they've averaged $1.39 per kilo milk solids, and the South over the last 5 years have averaged $2.01. So particularly strong in the South, which is interesting. As part of our data collection with the farmers, we do a survey with them as well. So we ask them things about what they anticipate their returns to be like for the coming 12-month period, and what their main issues of concern are to their business in a short-term period and a longer time frame. So in terms of expectations for returns, when we're asking the question, it's in that sort of July-August period when we're on farm. So we need to context it with the conditions that are being experienced and in the farmer's mind at the time. And, obviously we've had milk prices announced by that point as well. So this graph down the bottom here, it's cut off a bit, but, they're asked, do they see business returns improving, declining, or remaining stable? So most of our northern New South Wales farms view this current, so we're obviously in this current 12-month period, that they will either have improving or stable returns in this 12-month period. There are some anticipating a decline in returns. There's slight regional variation. The blue line is the South farms. sort of slightly better sense on what their, slightly better outlook on what they think their returns will be in terms of improving or remaining stable. I guess the difference between the north and the south in that improving, we had a number of farms that were in drought conditions at that point. So those seasonal conditions would certainly have been at front of mind when they were responding to that. In terms of the main issues for the next 12 months, which is this 12 months, seasonal conditions was the most highly ranked, followed by input costs, and then followed by labour. And when we look at that on a longer term horizon, so a 5-year period, it's quite similar. It's seasonal conditions, input costs, and we've also got labour and milk price in a longer term view. So the next section, this slide, I don't think I've presented a slide on greenhouse gas emissions in the past. So as part of Dairy Farm Monitor, a lot of the data that's actually physical data that's captured within Farm Monitor feeds into calculations for greenhouse gas emissions. And we do ask additional questions for this section as well. So within Australia, we have the Australian Dairy Carbon Calculator, which sits as a tool in its own right, but the methodology within Dairy Farm Monitor aligns with that of the Australian Dairy Carbon Calculator. Now, greenhouse gas emissions are not my area of expertise, so I do have a bit of backup on the call if there's any questions around this. But there's two things. We have total emissions on a farm, and then we have an emission intensity number that's generated for a farm. So again, what I'm about to show you is for the Farm Monitor farms. It's not for the New South Wales as a whole. It's a snapshot. If you'd like to get your own numbers, by all means, the Australian Dairy Carbon Calculator, you can use that. If you use Dairybase, there's just one more section in Dairybase, a few more details that you add in, and you will get your greenhouse gas emissions. They're the primary options, and it's no secret that there's a number of processes that are also helping farmers collect their numbers as well. So this first graph is net emissions, so total emissions from a farm represented in total tonnes of carbon dioxide equivalents per farm. We're looking at median emissions because there's the data isn't symmetrically distributed, so it gives us a better picture of what it is in that group of farms. There's been a couple of modifications made in the 21-22 year and the 22-23 year. So in the 21-22 year, carbon sequestered from trees has been factored in. In the 22-23 year, prior to this year, when we looked at how manure or effluent was handled within a business, we just used a state, what's called a state default value to calculate emissions from effluent. Now we ask more specific questions about how manure is managed on farm, because that impacts the emissions that are generated from manure. And the other thing was, in this year, we've also started to capture fuel usage by contractors when they're on farm, which is an industry standard way of measuring things as well. So we can see a slight uptick this year that some of those some of those adjustments have accounted for that increase, but there were slight increases in pre-farm emissions as a result of slightly more fertiliser and purchased feed in the diet, slight increases in nitrous oxide emissions, which is gas from wastes, effluent, fertiliser and ponds, and carbon dioxide emissions from fossil fuel consumption, so electricity and fuel. Interestingly, when we are looking at fertiliser, urea urea, when it is applied to the soil, also emits carbon dioxide to the atmosphere. So we account for it separately to other nitrogenous fertilizers. That's my fun fact for the day. When we look at emission intensity, so emission intensity is looking at your total farm emissions and dividing it by tonnes of fat and protein corrected milk, and factoring in meat production as well. So we can see that in this, there's not much of a difference this year compared to the 21-22 year, and that's at about 0.99 tonne per fat of fat corrected protein and milk. And obviously, this is median. There is a wide range of variation between the farms, depending on all the many variables and how they're used on farm and the resources they have. So that brings my presentation to an end. The Dairy Farm Monitor Project annual report should be up on the website today. It has been finalised. I'll also be doing a podcast which will be released on New Year's Day on the results of the project as well. And I think it's now 3 years we've had an interactive farm monitor report, which is the screenshot on the right here. And Juan Garjulio, my colleague and the person who has the software skills to create something like this, is just going to demonstrate this interactive report to you. It's a good way of visually looking at the data. So again, thanks to all the farmers and data collectors for their involvement this year. Hugely appreciated. And I'll take questions after Juan has done his presentation. So I'll just stop sharing my screen.
Thank you, Sheena. Great presentation. And good morning, everyone. I share the screen here. Can you see my screen now?
Sure can.
Yeah. So essentially, as Sheena mentioned, like results in general are presented. DFMP results are presented in the static report, the PDF released every year. But a couple of years ago, we developed an interactive web-based tool to essentially visualize in a more interactive way these results in New South Wales. And this tool uses all the years that we have available for these projects. 12 years. And the interesting part is essentially all the financial data is adjusted by inflation and presented in real dollars in this tool, so it's better for comparison between years. You can access this tool using this link and also scanning the QR code. I think Blake will also share the link in the chat. So I'll go straight to show the tool. So this is the landing page. Here we have some resources and some context on the DFMP. But essentially what we have here is different tabs that you can access. If you click on this general information tab, it shows different things here, but essentially this tab allows the user to explore information of specific regions or specific years. So for example, here what you can do is select the region that you want to explore. For example, if you click all farms, it will show all the farms. If you click north, it will show only the farms from the north region. And the same with year. Here is the latest financial year, but you can select the year that you want, and it will display the results for that particular year. So here what we have in this plot is the farms for that selection that you did are arranged by return on total assets, and so from the one with lowest return on total assets to the one with highest return on total assets. And you can see here the average for that group, which is 4.5 for the latest financial year. And what you can do also is if you hover over a specific farm, you can see additional information. Here, for example, you can see the return on total assets of that farm, the EBIT in kilos of milk solids, and the net farm income. The same, what we also can see is the main financial parameters. For example, gross income, milk income, variable overhead cost, EBIT, and then net farm income for that particular group that was selected, in this case for the North Farms. So for example, this is the gross farm income for all this group on average. So it's 13.32 kilos dollars per kilo of milk solids. And also we show here in liters, in dollars per liter. So it's $0.98 per liter. So yeah, we included this information because some farmers were also keen to have this data. And also here you can see also the mean or the average of the key physical parameters. For example, the number of cows, stocking rate, production per cow. Again, if you hover over the variable, you will see a brief explanation. I mentioned that in general we show here the mean for specific variables, in particular here the stocking rate, which we have some extreme values. We show the median here, but in general, what you can see here is average values. So this is one of the key tabs. Then if you go to this one, the historical information, essentially what we can see here is the historical trends of the different variables. And we include here two plots, so you can select one variable and also include another one to have more context or to compare variables. For example, here I can include the number of cows, big cows, and I have more context if I'm exploring, for example, return on total assets. But essentially here we can see the evolution of the historical trend for North and South farms. This is again the average for each year. And if you hover over, you can also see the value. So yeah, that's pretty much it. Then you have other tabs with glossary of terms and the contact, but that's pretty much it. Of course, happy to take any questions, and if you have any feedback, we are constantly updating this tool with the new year's data and also improving with feedback. So of course, if you have any feedback, get in touch with us. Thank you.
Thanks, Juan, and thanks, Sheena. Great presentations, great information. So we've got a little bit of time for questions. So is there anybody with a question? If you just raise your hand. And while we're waiting, Sheena, just interested in the top 25% compared to the average. Was there a significant difference between those two groups?
Yeah, thanks, Ken. Yes, so we look at top 25% of farm monitor farms, and that's based on return on total assets, the top 25. So look, it was a very strong performance in general for New South Wales, but the top 25%, they had an average EBIT of $4.27 per kilo milk solids. They had a lower average milk price than both the North and the South. Their average milk price was $10.65 for that group of farms. I think some of the key features with the top 25, and I'm talking on average, obviously there's differences, but they tend to be much more labour efficient than the rest of the farms in the data set. So, for example, the average labour efficiency labour efficiency when we look at that in terms of kilograms of milk solids produced per full-time labour equivalent. For Farm Monitor, on average, it's this year it was 37,430, but for the top 25 farms, they're generating 51,208 kilos of milk solids per labour unit. Other things, at a high level, total variable costs, they do, it's $1 less, $1 per kilo milk solids less than the average farm, sorry. Similarly, for total overhead costs, $1, they, are able to manage those costs well, and it's $1 less than the DFMP farms. Higher equity position in that group this year, 82% equity versus 72% for the average, and lower debt servicing as well. Interestingly, half the debt servicing of the average. So debt per cow was about $3,200 per cow compared to $6,100 for the DFMP farms. So at a high level, there are some standout differences between the top 25 and the Farm Monitor farms inherently. Yeah, thanks, Ken.
Sheena? Just another quick question. The record gross income, if you took out the grants, would they still have had a record gross income?
Yes, because grant income from grants is not factored in to gross farm income. It's netted off the relevant expense. Otherwise, it would distort the income related to the dairy business. That being here, that milk income, any livestock trading income, feed and water sales, if that's what what that farm does. Any sort of contracting farm, if the farm does contracting work as well, those types of farm generated income contributes to our gross farm income.
Thank you. We're out of time, so thanks everyone for joining us today. Sheena, the report is on DPI website if people would like to have a look at it. That's correct?
Yes, you can either access it from our DPI website under Dairy Farm Monitor, which it links back to Dairy Australia's location on their website, where they house every state's report. It should be up today on the website today. It wasn't there when I just logged in before the presentation, but it should be up there today.
Great, thank you. Great information, great presentation. Appreciate all of the farmers who participate in this project so that we can present this sort of information for the industry. So our next industry breakfast will be in March next year. Outside of that, I'd like to wish everyone a great Christmas and New Year period. Stay safe and look forward to catching up with you all in the new year. Thank you.